you. Brian Chung.
Brian Chung with Yahoo. Hi, Chairman Powell. Brian Chung with Yahoo Finance. I wanted to ask about financial stability, which is a part of the Fed's reaction function here. It seems like to people on the outside who might not follow finance daily, they're paying attention to things like GameStop, now Dogecoin. And it seems like there's interesting reach for yield in this market, to some extent also Archegos. So does the Fed see a relationship between low rates and easy policy to those things? And is there a financial stability concern from the Fed's perspective at this time?
Right. So we look at financial stability for us is really, we have a broad framework. So we don't just jump from one thing to another. I know many people just look at asset prices and they look at some of the things that are going on in the equity markets, which I think do reflect froth in the equity markets. But really, we try to stick to a framework for financial stability so we can talk about it the same way each time, and so we can be held accountable for it. So one of the areas is asset prices, and I would say some of the asset prices are high. You are seeing things in the capital markets that are a bit frothy. That's a fact. I won't say it has nothing to do with monetary policy, but it has a tremendous amount to do with vaccination and reopening of the economy. That's really what has been moving markets a lot in the last few months, is this turn away from what was a pretty dark winter to now a much faster vaccination process and a faster reopening. So that's part of what's going on. The other things, though, leverage in the financial system is not a problem. That was one of the four pillars. Asset prices was one. Leverage in the financial system is not an issue. We have very well capitalized large banks. We have funding risks for our largest financial institutions are also very low. We do have some funding risk issues around money market funds, but I would say they're not systemic right now. And the household sector is actually in pretty good shape. It was in a very good shape as a relative matter before the financial crisis. The pandemic crisis hit. There were real concerns, of course, with high levels of unemployment and loss of wages and all that the household sector would weaken dramatically. That hasn't happened. So with the fiscal transfers, money that's on household balance sheets, they're in good shape. You see relatively low defaults and that kind of thing. So the overall financial stability picture is mixed, but on balance, it's manageable, I would say. And it's, by the way, I think it's appropriate and important for financial conditions to remain accommodative to support economic activity. Again, 8.5 million people who had jobs in February don't have them now. And there's a long way to go till we reach our goal. So that's what I would say.
As a follow-up, you mentioned money market pressures. The Fed didn't make changes to interest on reserves or excess reserves. What was the logic behind that? It seems like SOFR has been drifting closer to zero. So just hoping for clarification on that.
Right. So the federal funds rate has been well within target and target range, and money market conditions are fine. We have the ability to use our administrative tools to make sure that remains the case. We do expect further downward pressure on rates through asset purchases and also the runoff in the Treasury general account. But at this point, we didn't see a need to deploy our tools to support rates, and of course we will do so if the need does arise.
Our questions. Over the past decade, the Fed has invested significant resources in large-scale bank supervision. It has completely overhauled that approach, and it's even created a special committee that looks horizontally across the largest banks to find common risks. Did the Fed not see that multiple banks had large exposures to Archegos? If not, why not? And then what regulatory changes would you like to see implemented to change that going forward?
Yeah, we supervise banks to make sure that they have risk management systems in place so that they can spot these things. We don't manage their companies for them or try to manage individual risks. In the grand scheme of these large institutions, the Archegos risks were not systemically important or were not of the size that they would have really created trouble for any of those institutions. What was troubling, though, was that this could happen in a business for a number of firms that is thought to carry relatively well understood risks. The prime brokerage business is a well understood business. And so it was surprising that a number of them would have had this. And it was essentially, I believe, the fact that they had the same big risk position on with a number of firms, and they weren't some of the firms were not aware that there were other firms that had those things. I wouldn't say it's in any way an indictment of our supervision of these firms. In some cases, it seems as though there were risk management breakdowns at some of the firms, not all of them, and that's what we're looking into.